Hello, welcome to Any Answers Answered for July 2021. As ever, Tim and I have had a look at some of the questions on the pages of Any Answers and have picked a couple to have a look at. And Tim, it wouldn't be 2021 if we weren't going to talk about COVID grants and the taxability of that. So let me give you the first question. It comes from S. Deus, and the question quite simply is, which box does the COVID small business grant go on in the tax return? They're trying to check exactly which box for both sole trader and the corporation tax return the small business grant for COVID should be included in. And we were also talking, Tim, on Tax TV this month about self-employed income support as well. This is a very important topic in terms of how we complete the returns.
No, let's make it clear that this question is about the small business grant, not the self-employed income support scheme grant. The small business grant was administered by local authorities, and typically a business occupying premises that were eligible for small business rates relief was able to claim £10,000 from the local authority. Larger businesses were able to claim more, and similar points to the ones that relate to the SBG, the small business grant, would also apply to the retail, hospitality and leisure grants. And that's what we're looking at. Now, in each case, these grants are to be treated as part of the business's trading profits. Of course, the government has not prescribed how businesses are to do their accounts, but it's clear from the commentary that's been developed over the last 12 months and more that these small business grants should be included as part of the accounts or part of the taxable profit for the period in respect of which the taxpayer, company or unincorporated business was eligible for those grants. And it's basically entitlement date rather than any sort of accruals basis that applies. And I'm not going to rehearse the rules under FRS 102, etc., because the question here relates to where does it go on the tax return? And I would say, if I was doing the accounts and tax returns, say for our software company, Absolute Accounting Software Limited, we would include, if we had, and in fact we did claim, we did then make a charitable donation equivalent to it, but we would include the SBG as part of our profits that would be reported simply as part of the overall turnover and profits of the business. But if you don't do that, then you would include it in the other business income section of the corporation tax CT 600 return. And similarly for a sole trader, it should be included as part of the trading profit, unlike the SEISS grant, which has its own box, and that would then be reported separately. But these SBG grants are not reported separately, and they would be part of the profit or part of miscellaneous income. And that's about it, really. The comments that were included in this thread make various suggestions, but I've got nothing further to add to those.
Okay, and just touching briefly on the self-employed income support scheme point, the issue there seems to be that whether you had repaid or you were thinking of repaying or had you claimed too much, that seems to be the big issue.
Yes, you certainly need to be very careful about the reconciliation between how much was originally claimed, how much goes on tax returns, and how much, if any, has been repaid or will have to be repaid because there were overclaims.
Our second question this month comes from Smithy51, and the question relating to capital gains tax on farmland. Question quite simply is, they are trying to report a client who has sold some farmland, no buildings, but using the new CGT form. And he's saying it will only calculate at 18 or 28%. So it's worth, even though there's no residential property, it's trying to charge the wrong rate of tax. And Tim, I think the first part of this answer is relatively straightforward, but there are other more interesting underlying points that I think you want to pick up on.
Yes, we're not given very much information, and I'm afraid the thread does generate fairly quickly into the sort of playground argument that I'm afraid occasionally we find on these AccountingWEB Any Answers. So not terribly helpful, but one or two of the answers do point out that perhaps Smithy 51 is barking up the wrong tree, because if we're looking at a simple disposal of farmland, then there is no requirement to report using the online reporting system, because that is only for disposals of an interest in residential property, and this is clearly non-residential. So the answer to the question, does anyone know how to report the sale of non-residential assets? The answer is on your self-assessment tax return, as we always have done. However, I think we do need to read a little bit between the lines, because it could be that this is the disposal of a country house, let's say, together with some farmland that's adjacent to it. So maybe there's an old farmhouse within a couple of acres of garden, but with maybe a 10-acre field attached. And that 10-acre field is non-residential. And there, on a disposal of the entire property, including the 10 acres of agricultural land, you would be required to report any chargeable gain giving rise to tax on the residential property, but not on the non-residential, because that would be on your ordinary self-assessment return. And I think what Smithy 51 might have identified is a potential failing in the online return system, because if we can argue successfully that some of the property is non-residential, then that shouldn't be subject to the online reporting requirement. So it may be that we need to look a bit carefully about how you actually report disposals where in a single transaction there is completion of a disposal of residential property, some of which might be chargeable because the main residence exemption doesn't apply entirely, and a disposal of some non-residential property which is not subject to the online reporting requirement.
Now, I think it's fair to say that a lot of people have misunderstood that 30-day principle and assumed it applies to all capital gains tax, where very definitely only applies to residential. But as Tim says, it can be quite problematic if we have bits of both to deal with. That's all for this month's Any Answers Answered. We take a break next month. Hopefully you will be able to as well. And Tim and I will be back in September to answer a couple more of your questions. But for now, bye-bye.